MoneyShow.com is proud to present to you this exclusive webcast presentation from the Las Vegas Money Show. Thank you for watching. Enjoy the show.
Good afternoon. I'm Howard Gold. I'm the editor-in-chief of MoneyShow.com, and I'll be moderating this panel. One of our panelists is on his way, but I thought I'd just get started with the introductions and then get right into our discussion. This is the Bulls or the Bears, and I know this has been a very popular workshop at the Money Show for many years, and this is my first time I'm moderating it, so I'm really looking forward to it, and I hope you are too. Let me just start by introducing the panels. On my right are the Bulls, and let's just go right to left. Louis Navellier is the editor of Emerging Growth, Quantum Growth, Blue Chip Growth, and Global Growth. He is chairman, chief executive officer, and chief investment officer of Navellier and Associates. In 1980, he began publishing his research in the stock advisory newsletter, the MPT Review. Mr. Navellier has been broadly publicized, including appearances on CNBC, Bloomberg, the Nightly Business Report, and Wall Street Week, and has been featured in Barron's, Forbes, Fortune, Investors Business Daily, Money, Smart Money, and the Wall Street Journal. Please welcome Mr. Louis Navellier. Also with us today is Joseph Battipaglia, Executive Vice President and Chief Investment Officer for Ryan Beck and Company, a subsidiary of Bank Atlantic Bancorp. He is the firm's chief investment strategist and spokesperson on investment policy. Mr. Battipaglia is also the chief investment officer of Washington Crossing Advisors, which is Ryan Beck's proprietary investment advisory program. He is featured frequently in national media, including CNBC, and speaks regularly with reporters from the New York Times, the Wall Street Journal, and other publications where his market views are often quoted. It is truly a pleasure to introduce to you Mr. Joseph Battipaglia. Now, as we move on to the Bearish side, I'm going to introduce Peter Schiff, President and Chief Global Strategist of Euro-Pacific Capital, a full-service NASD-registered broker-dealer which specializes in foreign securities. He is a recognized expert in the domestic and foreign securities markets, as well as the currency and gold markets. He speaks at major investment conferences, is quoted often in all the major newspapers and magazines, including the Wall Street Journal, the New York Times, Los Angeles Times, Barron's, and Business Week. His first book, Crash Proof: How to Profit from the Coming Economic Collapse, was published in March 2007 by Wiley & Company. Please give a warm welcome to Mr. Peter Schiff. And I'm going to introduce Marty, even though he's not here yet, to try to get that introduction done. Dr. Martin Weiss is the editor of Safe Money Report and the daily e-letter Money and Markets. He is the founder and CEO of the Weiss Group, which includes Weiss Research, Weiss Capital Management, Weiss Capital Securities, and the Weiss School. And there he is. And there he is right now. Dr. Weiss is also the author of Crash Profits, Make Money When Stocks Sink and Soar, and the New York Times bestseller, The Ultimate Safe Money Guide. So please give a hand to Dr. Martin Weiss. Good timing. So I wanted to start off this first, and we were going to allow a lot of time for crosstalk, but I just wanted each of the panelists to very briefly give me your views of the markets, the economy, and the world from the point of view of investors. And let's just start, again, right to left with Louis Navellier.
Well, great. Hot here? Okay. Is that hot?
Yes, we're hot.
Is it hot? Okay. Okay, now you hear me. Well, here's what's happening. Something odd's happening. Earnings are actually slowing down, and the economy's slowing down, but the market's been heating up. So I'd like to explain to you why that's happening. First of all, earnings aren't slowing that much. They grew for 18 straight quarters at 10% or more on the S&P 500 through the third quarter of last year. fourth quarter, they slowed down to 8.96. The first quarter earnings are coming out now. We're running about 8.65. Now, why the market got excited and the earnings are slowing down is depending on who you talk to, they expected those earnings to be up 3 to 5%. It turned out to be at 8.65%. So earnings were almost double what the analysts expected. And one of the reasons earnings are so strong, two reasons. Record corporate buybacks, which restrict the earnings per share, so that boosts earnings, and the weak dollar. The weak dollar is a windfall for all the multinationals. So the McDonald's, the Colgate-Palmolives, the Reynolds American, the Procter & Gamble's, the Cokes, all get extraordinary earnings from a weak U.S. dollar. So that's the good news. The bad news is the economy is really grinding to a halt here really quickly. We slowed to 2% in the third quarter, 2.5% in the fourth quarter. The first estimate of the first quarter is 1.3. Based on last week's trade numbers, they're going to revise it under 1. And this quarter's not shaping up very good because consumers are in a kind of a really bad mood right now. Retail sales were just hideous in April, and auto sales were horrific, even for Toyota and Honda. So what's happening is consumers are 70% of our economy. So in the midst of all this slowdown, why would the market be taking off? Multiple reasons. One is corporate buybacks are relentless, okay? A lot of that's because if you're an executive, you can pay yourself a salary tax at 35, or you can pay yourself a dividend tax at 15. It doesn't take very long to figure out 15% tax better than 35. So they like to buy their stock back, which boosts management's ownership, and then boom, here comes a dividend. Last 3 years we lost 506. Last 3 years we lost float. Companies are buying their stock back. All the mergers and acquisitions. Last year was $560 billion. We could lose $1 trillion in float this year. There's in Congress they're proposing taxing these private equity guys at a higher rate, so that just makes them rush to do more deals faster. The final reason is that there's no ifs, ands, or buts. The Fed will be cutting. And the reason they're going to cut is they want the core rate of inflation to get down to a certain level. There is plenty of inflation in energy. There's plenty of inflation in food. But the core rate excluding that is getting down the level where they'll soon cut. So next 5 to 11 weeks, we've got a Fed rate cut coming. And Wall Street's fully anticipating that. Plus market rates have come down. There was aggressive Asian buying last week. Drove market rates down. Fed never fights market rates. So you have a Fed rate cut coming. So this is kind of the soft spot here. Looking forward, we're heavy utilities, heavy defense stocks. The market will be getting more narrow, more selective, but it's still a bull market. We'll be headed higher.
Let me just add to that where we've come from, because I believe we're up approximately 18% in the averages since we were last together here. So clearly it paid to continue to have a bullish orientation. Now, the bears will tell you that other markets did better. That's true. But I realize now why you use the bear as a symbol for a negative attitude. Because when a bear hibernates, there's no one else allowed in the den. You never notice that? If anybody else tries to get in there, they kick them out. So I said last year that, look, there's room for everybody under this tent. And the fact that commodities were moving did not necessarily mean that everybody else is going to make money and the U.S. wouldn't. So here we are a year later, and the S&P is up some 18%. What has not been interrupted, to add to what Louis had just said, was the flow of trade and capital, globally speaking, as it relates to dollar balances held by foreign countries, the acceptability of our treasuries at these low interest rates. And because that relationship has not been unended, and no central banks around the globe are looking to take that on by doing something drastic, you have this condition now where multiples have become commonplace, risk premiums have been narrowed. That's not necessarily a lasting condition, don't get me wrong, but that's why we are at the point where we are today. And those flows of trade and capital continue unabated.
Okay. Anyway, well, first of all, I guess over the last year it has paid somewhat to be a bull, but I can tell you it's paid a lot more to be a bear.
Thank you.
Yeah, U.S. stock market has gained over the last year. but I can tell you as somebody who's invested in foreign shares for myself and my clients, the U.S. market looks like it's standing still compared to what's happening overseas. But I think you've really got to look at the markets more than just over 1 year. Because if you take a look at, going from 2000, when I believe the bear market began in U.S. dollar-denominated assets, if you look at what's really happened to the value of U.S. stocks and what's happened to Americans who have foolishly remained invested in U.S. securities over this period of time, if you price the Dow in terms of other currencies, for example, the euro, the Dow's off about 30% over 7 years. If you price it in other commodities that we buy, if you price it in milk, it's down about 35%. If you price it in corn or wheat, it's down about 40%. You price it in gold, it's down about 50%. Silver, 60%. In oil, the Dow is down by 70%. In copper, it's down by 80%. In uranium, it's down by 90%. And you can think of all sorts of things. You can look at how much did it cost you to have a stay in a hospital 7 years ago? How much was college tuition? How much was my homeowner's insurance or health insurance? And then you compare that to what's happened to the Dow. Just look at the price of a postage stamp, which just went up again. The value of the Dow is not keeping pace with the cost of living, with the consumer goods and services that we all hope to be able to afford. What's really going on is a lot of inflation. And sure, the inflation that's out there makes it look as if stock prices are rising, but they're not. The real values of stocks are falling. One of the main reasons that the Dow Jones has been strong recently is because you have a heavy component of multinational companies that generate a percentage of their earnings, in some cases significant, 30% or more of their earnings abroad. It's the foreign earnings that are helping these companies. Well, why even buy them? Why not just buy stocks in other countries where 100% of their earnings are coming from abroad? If the strength is in Europe and Asia, why settle for a company that's still got the lion's share of its revenues in the United States? And the biggest problem for our markets, and I still expect even nominal stock prices to turn down. At some point, they're going to turn down. But even until they do, it doesn't really matter because nobody is getting richer in U.S. stocks than when they can be invested abroad. But the problem is we have a phony economy, we have a bubble economy where better than 70% of our phony GDP numbers are generated by consumption. But the fact of the matter is, in order to finance that consumption, we've been on a borrowing binge from the rest of the world. We're borrowing tremendous amounts of money to buy products that were produced outside the United States. And the whole consumer spending economy has been supported by the real estate bubble. I've talked about that at length at previous bull and bear debates. We've finally seen evidence that it's beginning to crumble. The lax lending standards are coming back to bite the lenders. They're starting to reimpose lending standards. All these adjustable rate mortgages that people have been relying on, now they're starting to reset higher, so they can't afford, they don't have money to spend at Walmart anymore or at the Good Guys, or a lot of them can't even afford their new mortgage payments. Real estate prices are now starting to fall. And I think over the course of the next year, you're going to see them start to tumble. I think we're going to be in a recession. We're probably already in a recession. If you measure our GDP in euros, it's contracted by 15% over the last 7 years. I think if we had real inflation numbers, you would already see that we're in a recession. But I think we're going to be in a recession. It's going to be pretty bad, and we're not going to get any rate cuts. Unfortunately, the dollar is about to fall through the floor in its long-term support. And when that happens, both interest rates and consumer prices are going to head through the ceiling. And the Fed, unfortunately, is going to be forced to raise rates despite the fact we're in a recession, not lower them. And that's going to be terrible for our stock markets and our real estate markets and the economy.
Okay, thank you.
What bothers me about all this is that the dollar is not just falling against the big major currencies of the world like the euro or the Japanese yen or the Swiss franc. The dollar is falling against those currencies, plus it's also declining against the Brazilian real, the Polish currency, other Eastern European countries, other Latin American countries. In fact, this year, if you were to rank the performance of all the currencies of the world, the dollar would be in 51st place. There are 50 other currencies that are stronger. In fact, I was brought up in Brazil, so it's kind of interesting for me to recognize that the Brazilian real, the Brazilian currency, which was traditionally one of the weakest in the world, this year is the strongest currency in the world among the 16 major currencies that are tracked by Bloomberg. Can you believe that? The Brazilian real is not only doing better than the dollar, it's doing better than the euro and the Japanese yen, the Swiss franc, and the British pound. This is telling you something. It's telling you that a massive shift is taking place, a shift of wealth from countries like the United States to emerging nations. If the U.S. goes into a recession, then that means that instead of keeping all your eggs in just one basket, the United States and the U.S. dollar, you may want to seriously consider protecting yourself against the weaknesses here in the United States, while at the same time allocating some of your money to the countries that Peter was talking about. Does that make me a bear or a bull? Well, it actually makes me both. It makes me relatively bearish on the U.S. economy and relatively bullish on some of these major emerging markets overseas.
So given your points of view, how, very briefly, would you suggest people invest right now? Let's again start with Louis.
Well, Peter had a good point. I can't believe I'm actually going to agree with him. For every dollar that's gone into domestic mutual funds, $4 has gone to your national funds in the last 4 years. So your average stockbroker is telling his clients to leave the country. And we do international investing. We have our global letter. We're up 17% year to date. The problem we have is there was a correction a year ago in Latin America because Hugo Chavez was acting badly, and they shot the whole region. Marty's right. Brazil's fine. Colombia's fine. Chile's fine. Peru's fine. Mexico's great. Felipe Calderon's great president there. So that area here now. The correction we had this year in February and March, India's really looking bad. Okay, India guarantees lifetime employment to their civil service. You start a business there. You got to build your own utility grid. You got your own transportation. So, I mean, they'll still grow, but you know, a lot of the most ambitious Indians moved here or the UK. China's okay, but so much riskier than it was a year ago. Very volatile. So we do all this risk-adjusted stuff. It's very frothy there. Probably okay in the 2008 Olympics, but boy, is it volatile. Japan, I don't even go there because the dollar's stronger than the Japanese yen right now. So I don't want to ever have a currency headwind. Europe, sure, we're in Europe because we got our currency tailwinds. They're still tightening. We're not. But the problem is I got to pay a lot higher P ratio over there. But you know, we're up 17% global this year, so you know there's some hot spots. But how much should be your portfolio? 30% maybe. You know, you can buy the multinationals here that also play the same thing in our blue chip letter. But I can find more growth at home. Our quantum service is up already 30% year to date. Okay, a lot of great oil service companies that got that performance out of. So I'm actually doing better here at home. When I look at for the best PEG ratios, growth P ratios, I can get them a little better here at home than I can abroad. But there is a lot of money flowing abroad. And I just think you got to use a little common sense and mix it up.
Yeah, my fundamental premise in this discussion is that this is not a zero-sum game. So their gain is our loss, our gain is their loss. I don't expect things to end catastrophically with all kinds of Armageddon scenarios playing out. But rather, I do see global GDP continue to grow in fits and starts in certain places more smoothly in a developed world. And what you've got to do is move your growth portfolio where you want to take risk and not think about it regionally anymore or domestic foreign. Think about it in terms of best-of-breed companies. Because as these economies mature and companies stand up and take their place as global competitors, you can then include them in your portfolio very easily. And the barriers to doing that are coming down. The rules are getting homogenized. The cost of transactions are disappearing. So, you know, just to name a couple of industry sectors, and this is real trite, but you know them. You know, Toyota is better than General Motors in its category. I'm not saying whether you run out and buy it or not, but they've demonstrated you can make money globally in auto business. Nokia in its particular space. European pharmaceutical companies. Ethanol companies in Latin America who will someday, if we get our orientation right here, will get rid of the tariff, and all of a sudden ethanol is going to come in here from Brazil. These are the kinds of stocks that should populate your portfolio prospectively. So my fundamental case relative to the bear case talks about Armageddon and the zero-sum concept, which I think is not what's ultimately going to happen. I think it's global expansion to the benefit of everyone, and America will still be an important part of global consumption. Not only are we 70% consumer, but on a global basis, we consume 20% of the world's GDP. It's an important market for everybody here and overseas.
This is scary. This is scary.
So their gain is our loss, our gain is their loss. I don't expect things to end catastrophically with all kinds of Armageddon scenarios playing out. But rather, I do see global GDP continue to grow in fits and starts in certain places more smoothly in a developed world. And what you've got to do is move your growth portfolio where you want to take risk and not think about it regionally anymore or domestic foreign. Think about it in terms of best-of-breed companies. Because as these economies mature and companies stand up and take their place as global competitors, you can then include them in your portfolio very easily. And the barriers to doing that are coming down. The rules are getting homogenized. The cost of transactions are disappearing. So, just to name a couple of industry sectors, and this is real trite, but you know them, Toyota is better than General Motors in its category. I'm not saying whether you run out and buy it or not, but they've demonstrated you can make money globally in auto business. Nokia in its particular space. European pharmaceutical companies. Ethanol companies in Latin America who will someday, if we get our orientation right here, will get rid of the tariff, and all of a sudden ethanol is going to come in here from Brazil. These are the kinds of stocks that should populate your portfolio prospectively. So my fundamental case relative to the bear case talks about Armageddon and the zero-sum concept, which I think is not what's ultimately going to happen. I think it's global expansion to the benefit of everyone, and America will still be an important part of global consumption. Not only are we 70% consumer, but on a global basis, we consume 20% of the world's GDP. It's an important market for everybody here and overseas.
This is scary. This is scary. We're starting to agree more and more. A couple of years ago it was bear versus bull, clear cut. Now, on the other side of the aisle, they're talking about a weakening U.S. economy. And on this side of the aisle, we're talking about very bullish international markets. Who's the bull and who's the bear anymore? I'm saying, no, I'm just commenting. The focus I would place right now is on safety in the United States. And if you allocate, you certainly should keep still the majority of your money here because you're living here and you're paying your bills here, and your brokerage account is still denominated in dollars. So to invest in overseas is a higher risk for U.S. residents. If you were living in Europe, my allocation to the United States would be less than 10%. But if you're living in the United States, your allocation has to be much larger to the United States. But in what is the question? And I would continue to recommend in the United States that you focus on safety, which means things as dull and boring as U.S. Treasury bills yielding only 5%. Overseas, be it a third of your portfolio or more, if you're more aggressive, then my two favorite countries are still Brazil and China. And you don't have to pick stocks. You can buy the ETFs that are linked to their indexes. In Brazil, EWZ. In China, FXI is the most actively traded. And it's very, very gratifying to me to see those countries where they are today because I moved to Brazil originally when I was 6 years old. I was brought up there. I've lived in East Asia for many years. And so after all these years, it's finally happening. I'm very pleased to see that.
One point I want to make, Joe mentioned that it's, everybody wins. But, when it comes to foreign exchange, there are clear winners and losers. And when your currency loses value, you're getting poorer. And when your currency is gaining in value, you're getting wealthier. And what we're going to see is a major realignment of exchange rates to reflect the new reality of who is producing all the wealth. The reason the dollar became so highly valued and the reason Americans had a high standard of living was because we produced everything. We manufactured everything. We were the world's biggest producer. We were the world's biggest lender. We lent our wealth around the world. We had savings. and we enjoyed a lot of consumption. Today, that's not the case. You know, we're running a huge trade deficit, and we're borrowing money from everybody all over the world. And we're not borrowing to invest, we're borrowing to consume. And sure, we're still consuming a huge percentage of the world's output at the expense of people around the world who are working very hard, but in many cases are sacrificing and going without products because Americans are consuming them instead. I mean, there's not an unlimited or infinite amount of goods produced every year. There's a finite amount. And everything that's produced is going to get consumed. But who consumes it is who can afford to pay the most. And when Americans take their high-priced dollars to this global auction, we walk away with a lot of stuff. But when the dollar collapses, America's share of consumption is going to be brought in line to reflect the fact that we don't produce anything anymore, or not a lot relative to the rest of the world. So Americans collectively are going to be a lot poorer. They're going to consume a lot less. The rest of the world, particularly in Asia, are going to start to enjoy the fruits of their labor instead of giving them to us. They're going to consume a lot more. Their living standards are going to go up. And so if you want to be among the winners, you need to make sure that your savings and your investments are denominated in those currencies that are going to gain all the purchasing power that the dollar loses.
So how should people do that in their portfolio?
Well, it depends. I mean, personally, I'd invest it all abroad. I can't think of any reason to stay on a sinking ship.
Well, there's
let me ask one.
There's a problem with that, Peter. Let me just disagree with my fellow bear here for a minute. There's a problem with that because if your brokerage account is denominated in dollars and the dollar has a great rally, you're going to see that reflected directly in the form of a loss in your account if you're invested abroad.
Sure, look, I've been investing.
But if you have a dollar decline, provided it's not a catastrophic dollar decline, then it's not going to be at least immediately reflected in your brokerage account.
It doesn't. I try to encourage my clients not to even worry about how many dollars they have, because in the final analysis, it might not make any difference. I mean, there are plenty of billionaires in Zimbabwe, and they're broke.
It means that everybody seems much more interested in investing abroad, but the fact is, for the last several years, the international markets have way outperformed the U.S., and the large U.S. multinational companies have been the second worst performing asset class for the last 7 years. Haven't we seen this before in the 90s? Haven't we seen a weaker dollar in the 90s, and basically the pendulum swung the other way? I mean, I'd like to hear some reactions to that.
Well, the reason large caps did poorly is they changed the S&P 500 index. When you bought an index fund in March of 2000, you got 500 stocks, but you may not have realized that 54% of your money went to 7 stocks: Microsoft, Cisco, Intel, Oracle, etc. And the reason those things got inflated is every time you bought an index fund, more than half your index fund was chasing 7 stocks. And no one complained about this as long as it was helping the index. Well, ever since March of 2000, S&P cap weighting underperformed S&P equal weighting every year. So in an act of desperation, S&P tried to fix their index in 2005. And they took the top 100 stocks in the index and they reduced their weight dramatically. They crushed eBay. They crushed Qualcomm. They crushed 98 other stocks. They even hurt Walmart. It was called a free float adjustment. And what they did is they artificially deflated large cap and inflated mid cap. Now I run mid cap. I'm top 4% lipper last decade. Today in mid-cap, we have to pay a lot higher P ratio and get a lot slower sales and earnings. So large cap's in the bargain bin now. Everybody finally figured that out. All the strategists on Wall Street look at what they call the PEG ratio, price-earnings ratio. Everybody's calling for large cap. And it's finally happening, and it's a good area. But we have to, you can ask Sam Stovall, this S&P, what they were doing, and then we'll see if he gives you a good answer. But the truth of the matter is the global economy, the world's a small place. They all used to come here and list here, okay? But then we passed Sarbanes-Oxley and we chased them away. 5 years ago, the New York Stock Exchange led the world international listings. Now it's London and Shanghai. And nobody's coming back as long as we have Sarbanes-Oxley. And the truth of the matter is the currency is going to be probably soft for a while because when the dollar gets weak, our exports tend to go up. A lot of our economic growth, not in the first quarter, but in previous quarters, have been due to exports. So a lot of us here at home don't see it, but if you're in agriculture, you want a weak dollar so you can export more. If you're in manufacturing, you want a weak dollar so you can export more. So we'll see what happens. But according to Hank Paulson, who's the new Treasury Secretary, he doesn't seem too worried about the dollar being weak. unless it creates inflation. And right now it looks like it's going to bolster agriculture, manufacturing, and other places like that.
Well, I just skipped it. Oh, go ahead. I'm sorry.
Go ahead, Mark.
Well, I was, as I said, I was brought up in Brazil, in a country where the currency traditionally was going down, 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 down for years and years. And I fundamentally disagree with the idea that a falling currency, your money going down in value, is somehow good for the country. I don't accept that. And it certainly wasn't true for Brazil, and I don't think it's going to be true for the United States.
Especially when you mention, you talk about over 70% of our economy, unfortunately, is comprised of consumers spending. They need a strong dollar. That's what they're spending. We're taking our dollars that we print and we're exchanging them for the products that everybody else produces. And when that dollar falls in value, we're not going to be able to do that. Also, when the rest of the world realizes how much further the dollar is going to fall, they're not going to lend us any more money at single-digit interest rates. Remember, we have a negative rate of savings in this country, and the only reason that anybody in America is able to borrow any money is because someone in China or Japan is willing to lend it. But right now, they're losing out on those transactions. Whatever nominal, whatever interest rates we're paying them, they're losing it and then some in the foreign exchange. So the American consumer, more than anybody else, needs a strong dollar. Unfortunately, he's not going to get one.
We skipped Joe. I apologize.
The problem with just focusing on the currency adjustment is that there are unintended consequences of those changes. Let me paraphrase what Stephen Roche offered to Congress recently in talking about Congress bringing an action against the Chinese government and manipulating their currency. We had a similar situation in the 1980s with the Japanese. We claimed that they were managing their currency to keep it cheap so they can sell more Toyotas and everything else that they produce. They were buying an extraordinary percentage of our Treasury offerings. This was during the Reagan budget deficits, when we were supposed to have deficits for as far as the eye can see and debt for as far as the eye can see. You remember that. So the Japanese bent over and said, okay, fine, we're going to let the yen run. So the dollar in that world goes down, the yen goes up. Now what they got for their effort was no greater sense of sales or going down, or we weren't selling General Motors cars into Japan suddenly. What they got was a real estate bubble, a stock market bubble, and a collapse that they're still feeling the ill effects of, which has made the Japanese economy effectively and also ran in their own space. So they've been able to stay competitive globally, but their own economy suffered by their currency going up. The Chinese have seen this, they understand it, and they're not going to be persuaded to let their currency suddenly escalate by 50 to 100 or 150% for the virtue of blowing and imploding their own economy. They are too strongly dependent on the United States in that relationship, and they see what happened to Japan pulling the same maneuver. So when someone says currency going down is bad, let's also look at the other side when the currency is going up. And if anyone's going to sit here and tell me that Europe, with the euro, is the place to be, with 10% unemployment, a very significant social problem, governments now that are turning over with greater frequency, and you're saying that's the new world order for the next century, I think you're highly mistaken.
Yeah.
The Europeans with the high euro will become less competitive globally, and they'll be further behind the curve than they have been. The only sign of life they had recently was trying to break the social contract, and if they can't do that, they will slow even further.
A couple things. First of all, Japan just the other day announced a record current account surplus. Japan is making.
And how fast is the economy growing? Come on now.
They're operating in the black. We're operating in the red. A surplus in your current account is a good thing. Their economy is okay. They have some problems, but don't. The fact that the currency was strong was not part of it. A lot of it was their efforts to prop our currency up. But what's happening in China? The Chinese economy would so benefit from a dramatic appreciation of their currency. What's happening right now, and I use these analogies all the time, but it's a good one to explain it. But during the Second World War, a lot of people in this room probably remember that war. We had the wartime economy. We had all of our factories were engaged in production, 3 shifts a day, and they were making weapons and all sorts of things for the war effort. Meanwhile, back home, everybody was sacrificing, there was rationing. All of our productive capacity was being used to fight this war. And so that meant that We suffered at home because stuff that we used to be able to make consumer goods, we couldn't use it anymore. We had all these workers employed in the army, right? Now, when the war ended, we didn't have a depression. We didn't have a huge collapse in our economy because all of our soldiers were unemployed. All of our factories weren't making bombs anymore. What happened is we redeployed that labor. Instead of fighting a war, people came home and worked in peacetime pursuits. Factories retooled again. They stopped making bombs and started making sewing machines and washer dryers. And we benefited. Today, you have China fighting a war to support the American standard of living. And they're sacrificing, and goods are rationed at home. The Chinese citizens who are working in factories to produce goods that they can't consume because their own government is subsidizing our purchasing power instead. Once they let their currency collapse, their markets aren't going to disappear. They're going to emerge. As the American consumer dies, the Chinese consumer is going to be born. They're going to be far better off with their stuff and leaving us with our paper currency than making the exchange. And they're going to have the same type of economic boom that we had after the Second World War, when they freed up all of those resources that are now being utilized to satisfy our demands, and when they utilize those resources to satisfy their own demands.
Let's just look at some simple facts. In 2006, the U.S. S&P, regardless of how it's weighted, ranked 55th place in world stock markets. There were 54 other stock markets around the world that outperformed the S&P, sometimes by up to 10 times as much. In the first quarter of 2006, the ranking of the U.S. S&P fell even further down to 65th place. So now we have 64 foreign stock markets outperforming the U.S. And as I said a moment ago, our currency is 51st place, with some previous currency pariahs greatly outperforming the U.S. This is not good. This is not a positive picture for investors who want to stay fully invested in U.S. dollar investments.
Let me ask each of you, what could go wrong in your rosy or gloomy scenario? What's the unexpected thing people should look for, Louis?
Well, first of all, I have to address something Peter said. Peter's worried about a dramatic decline in the dollar. The last time we had a strong dollar was under Robert Rubin, Treasury Secretary under Clinton. And Alan Greenspan's actually on MarketWatch, a Dow Jones publication, mocking Robert Rubin today. Okay? So I don't really want to take either side here, but Alan Greenspan's pretty respected, and he thought Robert Rubin was full you-know-what. Now, here's the problem. I don't have any problem with us borrowing cheap from all these other countries. If Peter's right, one day interest rates will skyrocket. China, Japan, they'll all flee the United States. Our rates will be skyrocketing. Our economy will collapse on itself, kind of like a little black hole. The catalyst will be if rates are rising. Guess what happened last week? Rates plummeted on Treasury bills. For some reason, money was fleeing Asia, pouring into U.S. Treasuries, driving rates lower. When rates go lower, our Fed cannot. I used to work for the Fed 3.5 years. The Fed cannot fight market rates. They're going to have to cut. So there's not a problem now. Our country runs deficits with every continent except Antarctica, and all the money gets reinvested right back here. Okay? It's never been a problem. It's only going to be a problem if the capital gets up and leaves. Okay? And that's just not a problem. So I'm not worried about the doomsday scenario. Please remember, in the publishing business, we make more money when we scare people than when we tell them the truth. Okay? And the truth is, you just got to find your hot spots now. And the market will get more narrow. There's hot spots. The other thing is, the markets are always good in election cycles. For some strange reason, the third year of a presidential election term is always the best year for the market. Okay? I average over 50% every 4 years. Okay? And there's a joke in my office, I'm really good every 4 years. It's not me. It's election cycles. Between Hillary and Obama and Giuliani and McCain and Mitt Romney, we're all supposed to feel good. Well, the truth of the matter is one reason we probably feel good, other than we get entertained by these fellows, is at least Giuliani wants to do a flat tax. That gets a lot of people excited. Steve Forbes endorsed him. Mitt Romney wants to get rid of all taxes on capital gains, interest, and dividends. That's even more exciting. In fact, I'll get your senior citizen vote there. You want to see the savings rate in the United States go up? Take off the taxes. It'll skyrocket, because right now it's penalized relative to dividends and capital gains. So the market's going to be fine going into the election. As soon as we elect somebody, it'll go to pot again, okay? But really, for the next 15 months, we're going to be fine.
I question your slam at the intellectual integrity of those who try to tell the truth.
Well,
You know,
each of us have different views of the truth sometimes, too, so.
No, it's interesting. I recently got an email for I think one of Louis Navalier's newsletters, and it was almost like I wrote it myself, because the whole thing, it was talking about the foreign markets, how great they've done, how much better they've done than the U.S. markets, and why people should be investing abroad instead of in the United States. And then there was something I forget what you subscribed to, but it was the same stuff.
Do you stand by?
Me for being unpatriotic.
We're not anti-international. We like a currency tailwind. It's wonderful. We don't have one in Japan. Japan's weak against us. So we don't go there.
But
it disappeared in Latin America a while. It's coming back. Mexico's hotter than hot. We love a currency tailwind. Okay? I'm up 17% year to date in my global letter. However, in my quantum letter, I'm up 30%. Okay? Got a lot of oil service companies. I'm going to be realistic. I don't want to leave the country. Okay? Okay? It's the bottom line is there's a bit of balance here, and we'll go wherever we can find it. Okay? But right now, it's a little of everywhere, and it's getting a little frothy. If you do growth to P ratios, you're going to put you right back smack in large cap blue chip stocks, and they're doing great year to date.
I didn't hear anyone answer the question, though. Yeah. What could go wrong?
What could go wrong?
Well, I mean, what could go wrong if Peter's scenario goes wrong? It'd be when interest rates skyrocket. The opposite is happening. They're coming down now.
Okay? What could go wrong?
They came down heavily last week because of Asian buying. So, but if you see, let's just say, rates skyrocket, then we're in trouble. Okay, that'll really kill our economy. Right now, the opposite is happening.
Came out today. They were much weaker than forecast. I mean, it was a much lower number. I don't know where you're seeing all this influx of foreign buying.
Treasury bond yields plummeted late on Thursday and Friday.
I mean, what's your definition of plummeted? They couldn't have gone down much.
They went down 20 basis points on the six-month Treasury.
Let's go back to
for 2 days.
Let's go back to the question, Joe. What do you think could go wrong with your scenario?
Yeah, I disagree with the bearish case that the international operation of China Inc. is just on a parabolic curve straight up. I look at China as an emerging market with all the attendant risks. The stock market was up meteoric the last 12 months. It is prone for a dramatic correction. What you saw in February had a reverberating effect internationally. And I'm most worried about unintended consequences. You cannot sell out of China that easily, but you can sell U.S. equities or any other equity you choose in lieu of China breaking up. And that's why all the markets in sync went down and went down hard. This could happen again, and it may be such a situation where it keeps everybody in a very negative point of view from an investment perspective. The second risk factor is the Straits of Malaga and also the Gulf of Hormuz is where 70% essentially of all this global trade is moving through. Leave the currencies out. Let's talk volume. Any terrorist worth his salt would target those two areas to impact the global economy and the American economy directly. The U.S. Navy is continuing to do a great job protecting those areas, but they are vulnerable. So if something were to happen there and you have to wait in line or go on Alternative Tuesdays to get a gallon of gas, you can forget the bull case both here and internationally.
I agree with that. And the two countries you should watch very carefully, not only Iran, which New York Times said this morning, I believe, that has advanced far further in its nuclear development than we had previously believed, but also Pakistan. Pakistan is a powder keg, and if that becomes unstable, then all bets are off, both for the domestic bull side and international bull side.
How about the bearish side? What could go wrong for the bearish side?
What could go wrong with the bearish side is that if you want to put a bullish spin on this entire scenario, you would have to say that the United States is emerging as a very strong caboose in a train whose locomotive is being driven by other stronger currencies and stronger currencies. Just this week, a lead article, also in the New York Times, front page, said that very soon more than half of the revenues from the S&P 500 companies are going to be derived directly or indirectly from overseas sales.
Right now it's 30% actually.
Right. They were saying close to half already. And so that would imply that strength overseas, if it continues, could nullify the bear case for the U.S. economy. What's weighing on the U.S. economy now primarily is the housing crisis and its consequences.
Okay, Peter, what could go wrong with your scenario? And then we have to wrap up.
Well, basically, the foreign central banks have been big buyers of dollars, picking up the slack. Private foreign citizens have already wised up. They don't want our dollars anymore. They're not investing there. But central banks throughout Asia are buying dollars, are buying them, in unprecedented quantities. And if that continues for a number of years, then the consequences that I'm foreseeing, might be delayed for a couple of years, but only at the expense of exacerbating the problems and making it that much more difficult when they finally come to their senses. Because, unlike, Louis, I just don't believe that foreigners are going to lend us money forever and never expect to get paid back. And the problem is money supply growth around the world is double digits. The world is creating a tremendous amount of inflation to prop our currency up and keep it from collapsing. And if foreign central banks want to play around with their CPIs and try to deny that the inflation actually exists so they can keep on printing money for a while longer and propping up our economy, then maybe we can get away for a couple more years. But there's a good chance that we don't, and it'll hit the fan a lot sooner.
Think about this. Is it possible to say that our country having a trade deficit of close to $800 billion is a good thing? Is it possible to say that owing $2 trillion to foreign governments and foreign private institutions is a good thing? I agree with Louis that it may not be a problem today. It may not be a problem tomorrow. It can continue on for a while. But not being a problem in the very near term is a very nearsighted statement, in my opinion. If you want to be farsighted and think about the benefit, the good of our country as a whole long term, you cannot accept those deficits going on and our dollar declining and us becoming the caboose of the world economy.
Okay. Well, thank you. At least there was a little bit of agreement here, but plenty of disagreement too. Thanks.